So you want to own a shopping mall. Buy the building, fill it with stores, collect the rent checks every month while thousands of people do your marketing for you just by showing up. Sounds passive, sounds clean, and here's the thing nobody tells you before you sign the papers. The mall was never really built for the shoppers. It was built to trap them. And understanding exactly how that trap works is the difference between owning one of the most profitable real estate assets in the country and inheriting a very expensive, very empty concrete box. What I mean is, there is what owners do, the way they build these buildings. It is built to trap you inside, shows you more of what is inside, that way you stay stuck inside. By the end of this, you'll know what it actually costs to get into this business at every level, how the physical design of the building is doing financial work you'd never see on a balance sheet, what a co-tenancy clause is, and why it's the single most dangerous piece of language in any mall lease, and why a mall that was 98% occupied one decade can be a pile of rubble the next. Let's start with the price of entry. A small strip mall, 20 to 40,000 square feet, anchor-free suburban location, you're looking at $2 to $5 million to acquire an existing one. That's the entry level. A mid-size enclosed mall, maybe 400,000 square feet, one or two anchor stores, regional draw, you're spending anywhere from $50 to $200 million, depending on location and condition. Then there's the top tier, a Class A regional mall near wealthy suburbs, luxury anchors, high sales per square foot, brands on a waiting list to get in. Those trade north of $1 billion. Simon Property Group, the largest mall owner in the United States, owns or has interests in over 200 properties. Their portfolio is worth north of $30 billion. You are not Simon Property Group, but understanding how they think about this business tells you everything about how the math works at every level below them. Now here's the part that stops people cold when they first hear it. The mall wasn't designed for shoppers. It was designed against them. Alfred Taubman, the Michigan developer who more than anyone else shaped the modern American mall, didn't just build shopping centers. He studied human movement the way a casino studies gambling behavior, then built the building around what he found. Anchor stores are spaced roughly 3 city blocks apart from each other, not for convenience, but so that every shopper walking between them passes dozens of smaller storefronts along the way. Escalators and elevators are placed at the ends of corridors, not the middle, so you walk the full length of the hallway just to change floors. Skylights are mixed with artificial lighting, calibrated to make it impossible to tell how much time has passed since you walked in. There are no clocks anywhere. The floor plan loops back on itself so that leaving requires almost as much walking as arriving. None of this is decoration. Every single choice is a financial decision, disguised as an architectural one, because every extra storefront your eyes pass across is another chance for a tenant to make a sale, and every extra sale above a certain threshold triggers percentage rent, which goes straight to you. If you're finding this interesting, hit subscribe. We do this for new business every day. All right, here's the trap underneath all of it, and this one will cost you everything if you don't see it coming. Buried inside almost every mall lease is something called a co-tenancy clause. It says, in plain terms, that if a major anchor store closes, every smaller tenant around it has the legal right to pay reduced rent or walk away from their lease entirely. You don't see this on the day you buy the mall. You see it the day your anchor tenant announces it's closing, and suddenly a dozen stores are legally paying you less or nothing at all without breaking a single contract. One closure doesn't just remove one rent check, it can trigger a wave of reductions across the entire building simultaneously. This is exactly what happened when Sears filed for bankruptcy in October 2018. At the time, one major mall owner had Sears stores in 59 of its properties. Another had them in 40. Across the industry, roughly 80% of Sears-branded stores were inside regional malls. When they closed, co-tenancy clauses fired across hundreds of properties at once. And filling that empty anchor space wasn't simple. These boxes run over 100,000 square feet, built for one specific kind of tenant, with loading docks and floor plates that don't convert easily into anything else. One mall owner spent $100 million over 3 years just to subdivide a single old Sears building into 4 smaller stores. Rolling Acres Mall in Akron, Ohio, opened in 1975 with over 140 stores and 5 anchor tenants. By the mid-1990s, it was 98% occupied. It sold for $1.6 million in 2006. The interior closed in 2008. By 2013, it was completely empty. Copper thieves stripped the wiring. Rain poured through broken skylights for years. The city took ownership after the owners stopped paying property taxes, owing over $1 million in back taxes. The building was demolished between 2016 and 2019. Amazon built a distribution center on the same land. So here's what the math looks like on 2 real outcomes. Optimistic version, you acquire a well-located mall for $80 million, maintain strong anchor tenants, keep vacancy below 10%, and generate $6 to $8 million in net operating income annually. That's a real return on a real asset that appreciates over time. Realistic version, 1 anchor closes, co-tenancy clauses trigger, 4 smaller tenants reduce rent by 50%, 2 more leave entirely when their leases expire, and your net operating income drops by 30 to 40% in a single year without you doing anything wrong. The building didn't change. The financial structure underneath it did. The mall looks like a building. It's actually a trap. The only question is whether it's trapping shoppers or trapping you. If this hit different, like, comment, and subscribe. We've got a lot more of these coming.